Welcome to this explainer on IAS 40. Today, we're taking the complex technical requirements for investment property and translating them into a highly structured, actionable playbook. Whether you're trying to classify a brand new commercial building or figuring out exactly how to account for a sudden change in property use, consider the standard your definitive guide. Let's unpack these rules so you never misclassify an asset again.
Here is our playbook for today: scope and objective, recognition criteria, measurement models, transfers and disposals, disclosures and judgments, and finally, interactions and errors. Let's jump right in.
Section 1. Scope and Objective.
So, what is the fundamental objective of IAS 40? Well, it's designed to prescribe the exact accounting treatment and disclosure requirements specifically for investment properties. We're talking about property, whether that's land, a building, or even just part of a building that you're holding on to earn rentals, for capital appreciation, or both. What really sets an investment property apart is that it's essentially a standalone cash cow. It generates cash flows completely independently of the rest of your business operations. And keep in mind, this applies to owners of property, but also to lessees holding a right-of-use asset under IFRS 16 that meets this exact definition. Now, it is absolutely crucial to immediately carve out what is out of scope here. We have to rely on strict exceptions where other standards automatically take precedence. You apply IAS 40 except when the asset is a biological asset related to agriculture. That actually falls under IAS 41. You also apply it except when you're dealing with mineral rights. And unless the property is owner-occupied, if you're using the building for your own corporate headquarters, that's IAS 16 territory. Finally, you shall not apply this standard to property being developed for sale in your ordinary course of business. That's just inventory, which is strictly covered by IAS 2.
Section 2. Recognition Criteria.
Once you know you're in scope, how do you actually bring the asset onto your books? You'll recognize an investment property when all of the following criteria are met. First, if it is probable that future economic benefits will actually flow to your entity. And second, if the cost can be measured reliably. Then you can officially recognize the asset. And to be clear, both of these conditions must be fully satisfied at the exact time the costs are incurred.
Applying this conditional logic to subsequent costs helps you easily separate major capitalizing events from routine expenses. If you're incurring costs for a major replacement, let's say completely tearing down and putting in new interior walls, then you capitalize that directly into the carrying amount of the property, as long as it meets those recognition criteria. On the flip side, if the cost is just for day-to-day servicing, like, paying a plumber to fix a leaky toilet, then you have to expense it immediately in your P&L. Routine maintenance doesn't magically make the building more valuable.
Section 3. Measurement models. When it comes to initial measurement, it is strictly cost-based. You measure the investment property at its cost, which is the purchase price plus any directly attributable expenditures. So let's look at what's included. If your transaction is buying a massive commercial plaza to hold for rental income, you naturally include the purchase price, professional legal fees, and property transfer taxes. But pay close attention to what's excluded. You must absolutely strip out startup costs, any operating losses you incur before reaching your planned occupancy, and definitely any abnormal wasted materials from the construction phase. Now for subsequent measurement, you face a massive policy choice, and it's a real game changer, because whichever you choose has to be applied to all of your investment property. If you adopt the fair value model, then you must revalue the asset to its current market exit price at every single reporting date. Where does that go? Any resulting gain or loss flows directly to your profit or loss for the period. Alternatively, if you adopt the cost model, then you simply carry the asset at cost less accumulated depreciation. And where does this impact land? It flows systematically to your P&L via your regular, predictable depreciation expense. But you need to watch out for a very strict limitation here, except when fair value is not reliably measurable on a continuing basis. This is rare, but it typically happens on initial recognition. Maybe you have a property under construction in a completely frozen, stagnant market. If that rare situation occurs, then you are explicitly prohibited from using fair value for that specific asset. You actually have to revert to the cost model under IAS 16, and you must assume a zero residual value until disposal.
Section 4. Transfers and Disposals. Okay, transfers in or out of the investment property category. These can only happen when there is an objectively evidenced change in use. Management just changing their minds? Not enough. If you transfer an investment property currently carried at fair value to an owner-occupied property, then you use its fair value at the date of that change in use as its brand new deemed cost. Where does this go? It becomes your new baseline on the balance sheet for future depreciation. Conversely, if you transfer an owner-occupied property to an investment property carried at fair value, then you revalue it to fair value at that exact date. And where does the difference go? Any resulting increase is recognized in other comprehensive income. It bypasses your daily P&L and sits in a special equity bucket called revaluation surplus.
Eventually, it might be time for derecognition if the asset is disposed of, say through a sale or a finance lease, or if it's permanently withdrawn from use with absolutely no future economic benefits expected, then you just calculate the difference. You take your net disposal proceeds minus the carrying amount. And where does that go? That net difference drops straight into your profit or loss for the period, effectively clearing the asset off your books.
Section 5. Disclosures and Judgments.
Providing total transparency to your stakeholders is absolutely mandatory here, and you have to separate your narrative disclosures from your hard quantitative figures. Qualitatively, your investors need to know the accounting model chosen. Did you go with fair value or cost? They also want to know if an independent qualified valuer was involved. Quantitatively, it's all about the cash impact. If the fair value model is used, then you have to provide a detailed reconciliation of carrying amounts from the beginning to the end of the period. And regardless of your model, you must explicitly disclose the exact rental income derived, alongside the direct operating expenses you incurred to generate that rent.
Now, we have to flag a major estimation uncertainty right here. The standard explicitly demands professional judgment when a property has mixed uses. Think of a building where the ground floor is a retail space you rent out, but the top floor is your own corporate headquarters. If those portions cannot be sold separately, it only qualifies as an investment property if an insignificant portion is held for your own use. But what does insignificant actually mean? Because that word is highly subjective, you have to formulate and formally disclose the specific criteria your management uses to exercise that judgment consistently across the board.
Section 6. Interactions and Common Errors.
IAS 40 does not exist in a vacuum, right? It interacts strictly with several other major standards. For instance, it defers to IAS 16 for owner-occupied rules, which instantly overrides IAS 40 the second a property's use changes to internal administration. It defers to IAS 2 when defining inventory boundaries. It's used right alongside IFRS 16 for right-of-use investment property. And crucially, it defers entirely to IFRS 13 for the actual mathematical mechanics of calculating fair value. Also, a quick pro tip on transitional provisions: if you're adopting IFRS 16, dealing with a business combination, or changing your policy between fair value and cost, IAS 40 actually provides specific retroactive transition relief, so definitely double-check those clauses before you go restating years of past financials.
Let's wrap up our playbook by looking at some frequent application errors that catch practitioners off guard. Mistake number 1. Reclassifying an investment property to inventory simply because management makes a strategic decision to sell it. The correct treatment? The property remains an investment property right up until actual derecognition, unless you physically begin developing it with a view to sale. Mere intention does not trigger a transfer. You absolutely need physical action.
Mistake number 2 is a classic: double counting. Practitioners often try to value an entire building and then separately recognize the elevators or the office furniture inside it as property, plant, and equipment. The correct treatment is that you must not double count. If an office is leased out on a furnished basis, the fair value of that investment property already incorporates the value of the furniture that's generating the rent. You shall not recognize those items as separate assets.
And as we touched on a bit earlier, mistake number 3 is artificially inflating the asset's carrying value with daily bills. Never, ever capitalize your daily maintenance bills into the property. Remember our rule: if it is a day-to-day servicing cost, like a plumber fixing a leak, then it goes straight to the P&L in the exact period it is incurred.
As we conclude this explainer, I want to leave you with a provocative thought about the real-world application of all these rules. Imagine the commercial real estate market suddenly stalls tomorrow. Comparable transactions vanish entirely, and fair values become absolutely impossible to measure reliably on a brand new development. Ask yourself, is your accounting system prepared to seamlessly handle the strict exceptions of IAS 40 and immediately revert to a zero residual cost model? Understanding the deep nuances of this playbook ensures you're never caught off guard. Thank you for joining me to explore the precise mechanics of investment property.